Good morning, this is DrFinance, and you are tuned into the only place that matters for unfiltered macroeconomic reality. Look around you, the narrative is fractured, the consensus is crumbling. We are not in a period of smooth digestion, we are in a period of violent structural repricing. Forget the soft landings everyone is wishing for. We are navigating the gravitational pull of tightening liquidity, and the market is finally starting to feel the weight. The key theme this morning is deleveraging pressure. We see it across the board. Equity futures are heavy, driven not by imminent earnings catastrophes, though those are coming, but by the sheer, inexorable cost of money. The market has spent the last decade feasting on zero. Now, the bill is due, and the appetite for risk has evaporated faster than confidence in an over-leveraged mid-tier bank. This is where true capital allocation decisions are made, not when everything is going up, but when the tide rips out, exposing the rotten foundations underneath. Let's dissect the current landscape before we plunge into the mechanics. The data speaks volumes, if you bother to listen. Bitcoin, our bellwether for speculative excess, sits at 86,956.41. That's a nasty drop of 1.38% overnight. It signals that when the funding markets seize up, speculative, yield-free assets are the first casualties. Ethereum, looking equally uncomfortable at 3,005.50, down 1.80%. The narrative has shifted from digital gold to high beta junk in the current tightening cycle. In the FX space, we see the dollar pausing for breath, but the underlying trend remains firm. EUR/USD is creeping up slightly to 1.18, a marginal positive movement for the Eurozone periphery, but don't mistake a momentary dip for a systemic reversal. The Fed's stance is structurally firmer than the ECB's, and that interest rate differential remains the dominant gravitational force. Volatility indexes are ticking up, quietly. This isn't panic yet, it's nervous professionalism. The VIX is pricing in higher uncertainty over the next 30 days, but the real action is in the term structure. We are seeing dislocations in short-term rates that scream underlying operational stress. Liquidity is not infinite, and when large players need to square up margin calls, they sell what is easiest to liquidate, and that is often your favorite growth stock or your speculative crypto. Remember this rule: illiquidity precedes insolvency. Now, we turn to the core engine of global finance, the sovereign debt market. This is where the real battle against inflation is being fought, and frankly, the bond market is winning. The 10-year Treasury yield is the global risk-free benchmark, and its movement dictates the valuation of every asset on the planet, from your mortgage rate to the P/E ratio of a tech giant. We are seeing consistent pressure upward. The yields are reflecting genuine term premium return, investors demanding higher compensation for locking up capital for a decade because they do not believe the inflation problem is solved. The flattening of the yield curve continues to be the single loudest macro warning signal available to us. Specifically, look at the spread between the 2-year and the 10-year. When that spread narrows to near zero, or inverts, it is a historical signal of impending recessionary conditions. Why? Because the market is telling the central bank, we believe your short-term medicine, high short-term rates, will successfully kill future growth. We are currently riding the razor's edge of inversion. Short-term yields are anchored by immediate policy expectations, which are aggressive. Long-term yields are being pushed higher by inflation expectations and supply dynamics. The market is pricing in a significant slowdown in the latter half of the year, driven entirely by the lagged effect of monetary tightening. This isn't speculation, this is debt physics. If the curve inverts fully, prepare for a substantial re-rating of equity valuations across the board. Do not dismiss the curve. It holds more truth than any press release issued by a politician or a central banker. Let's address the actors orchestrating this tightening cycle: the Federal Reserve and the European Central Bank. The narrative from the Fed is clear, uncompromising, and necessary, although painful. They have finally accepted that inflation is not transitory. Their rhetoric is hawkish, and their actions follow suit. We expect further aggressive moves. The market is currently repricing the terminal rate higher with every data release that shows stickiness in core services inflation. The key vulnerability for the Fed right now is the lag. Monetary policy takes 12 to 18 months to fully impact the real economy. They are tightening into an economy that is already showing signs of slowing consumption and tightening credit conditions. This is the razor's edge. Overshoot, and you engineer a hard landing; undershoot, and you bake inflation into the system for a decade. DrFinance believes they are currently priced to overshoot. They must maintain credibility. Across the pond, the ECB faces a more complex dilemma. They are dealing with inflation driven by external energy shocks while simultaneously trying to manage the structural fragility of the Eurozone periphery. Their path is slower, more fragmented, and frankly, more dangerous. They are trying to thread a needle while the building is on fire. We are watching sovereign risk spreads tighten in Europe, an early indicator that bond market participants are getting nervous about the fiscal capacity of heavily indebted member states to weather higher borrowing costs. The divergence between the Fed and the ECB means structural weakness in the euro-dollar pairing remains the favored trade direction. Commodities reflect real-world supply and demand imbalances, unvarnished by financial engineering. Gold, the traditional inflation hedge, the safe haven, is acting strangely. It's consolidating, showing weakness near key resistance levels. Why? Because when real short-term rates rise aggressively, the opportunity cost of holding a zero-yielding asset like gold becomes prohibitively high. Gold thrives when inflation expectations are unanchored and nominal rates are suppressed. That is not the environment we are in today. We are in a real rates rising environment, which is negative for gold until we see a clear break in the yield curve action. Oil prices remain elevated, supported by geopolitical risk and tight supply management from producers. While demand destruction is a concern as manufacturing slows, the supply side remains inelastic. This provides a persistent inflationary floor under the entire economy. Copper, the industrial barometer, drive. Copper is showing signs of distress. A slowdown in global physical demand, particularly out of China, is putting downward pressure on prices. This is a critical warning sign. When copper rolls over sharply, it often precedes significant downturns in global manufacturing output. Watch copper closely, it's signaling recession well before the equity index starts to tumble seriously. Where is the relative strength? In this environment of high rates, credit crunch fears, and inflation, you must favor two things: essential services and pricing power. The clear winner in this cycle is energy infrastructure and select producers. Why? Because the global energy transition is taking longer than anticipated, geopolitical supply risks are persistent, and crucially, they possess genuine, hard asset-backed pricing power. They aren't selling hope, they are selling barrels of oil and MMBTU of gas. Margins are robust, and their balance sheets are benefiting from high nominal revenues. Contrast this with the highly leveraged technology sector, reliant on cheap future cash flows discounted at a much higher rate. Their valuations are structurally impaired until real rates stabilize or drop. Stick to the tangible. Stick to cash flow generation that is proven today, not hypothesized in 2027. Back to the digital periphery. Bitcoin's reaction to systemic liquidity drain confirms its current classification, high beta risk asset. We are testing critical support levels right now. The psychological $85,000 region is under siege. If we see a definitive daily close below $86,000, the next stop is significant downside toward the $78,000 zone, where we might find some technical stabilization based on longer-term moving averages. However, the fundamental driver remains external, global risk appetite. As long as central banks are tightening the screws, crypto acts as a highly sensitive lever. Do not mistake consolidation for recovery. This market is currently responding to financial gravity. Strategy is paramount when volatility rises. Cash preservation is wealth preservation. 1. Defensive posture, reduce exposure to highly speculative, unprofitable long-duration assets. If you can't articulate how the asset makes money now, sell the excess. 2. Dollar strength, maintain long exposure or reduced short exposure to the US dollar against weaker, policy-divergent currencies. The dollar remains the ultimate safe harbor in global financial stress. 3. Rate hedges, if you are positioned long in equities, ensure you have hedges against rising yields, either through shorting duration ETFs or buying specific interest rate options. The bond market is not done moving. The data today demands caution. We are looking for confirmation that the selling pressure is purely cyclical profit-taking or if we are entering a systemic deleveraging phase. Current signs point aggressively towards the latter. The era of easy money is over. The hangover is setting in. Markets are currently struggling to price in the full weight of necessary monetary restraint. We are seeing oscillations driven by headline noise, but the underlying currents, higher discount rates, tightening liquidity, and genuine recessionary signals in the bond curve, are unchanged. Do not be swayed by short-term rallies that look like hope. Hope is not a strategy. Reality is a balance sheet reduction. Stay disciplined, adhere to your risk parameters, and understand that volatility is not an anomaly, it is the new regime. This has been DrFinance. We will reconvene tomorrow to dissect the next phase of this structural correction. Stay focused.